There is a 95% chance the RBA is about to cut interest rates. This is massive news for the property market. Bigger still, most economists are predicting at least 4 interest rate cuts that are going to follow this one. It is huge news that turns the entire property market upside down. And if you're a homeowner, a renter, or a property investor, this video is going to tell you exactly why interest rates are coming down and what it means for you. Your borrowing power about to surge. Property prices about to start its next cycle. Investors, this video is going to teach you exactly how some markets are going to benefit and others may actually see a fall as a result. Let's go. So let's unpack why rate cuts are all of a sudden here and coming in quite fast. 4 rate cuts after a few years of no rate cuts and only rate rises is quite the turnaround. But really, it's not all that much of a surprise. Underlying this is inflation has been beaten and it's come back down. The key number to all of this is inflation. It's how quickly prices are rising. Now that inflation is coming down to the level that the RBA actually want, they can bring interest rates back down to a normal level. Right now, they have repeatedly said, we are restricting the economy. We're slowing it down. We're holding it back. We're going, hold you back, economy. That's what the RBA has been doing to get inflation back under control. Now, they've been doing that for a couple of years. They've been talking about it. They've increased interest rates so many times. I've lost count. We're at a 4.35% cash rate. And now they can be like, actually, economy, you can go a little bit. You can go a little bit. 1 rate cut, that's nothing. It actually barely changes a thing at all. 2 rate cuts, it has some sort of impact. But 3 or 4, now you start feeling that in your back pocket. And you're like, the numbers change as a result. So it's all from the latest inflation report card that is driving this big change. It's given the RBA everything that they need to start cutting interest rates. Here's the main message. The 6-month annualized underlying inflation rate has dropped to 2.7%, meaning that inflation isn't just slowing, it is now well within the RBA's comfort zone. This has changed market data fast. The RBA rate tracker jumped from a 73% chance of a rate cut to a 95% the minute the inflation data came out. So what did I just say? What does all that mean? It means that inflation is back to where the RBA needs it to be over the last 6 months. Now, when you read report cards and you go on the ABS website and you look at underlying inflation, you're like, okay, that's at 3.5%, somewhere in that vicinity, more than the RBA want. And yes, that's right. But that's using data over the past year. When you look at over 6 months, it is at 2.7%, which is almost exactly where the RBA needed to be. Just a few percentage points away. That makes it very much in line with what the RBA want to see. That is the key message as to why they can cut interest rates now and why they don't need to hold the economy back. If the interest rate was at a level where the economy could function normally, then they wouldn't be cutting rates. But right now, they're basically holding someone by the knees and being like, stop moving, stop moving, stop moving. That's kind of the RBA at the moment. And they can be like, okay, we're going to gently loosen our grips a little bit. And then eventually we're going to be like taking our grips off altogether and being like, look, economy, you go walk around, be free, do what you need to do. Like, you are under control. You have inflation under control, which is exactly what they've been trying to manage. They don't need to have it so tight anymore. That's why there's 4 rate cuts coming this year. We don't know exactly the number yet, but we almost have certainty that the first one is here. And the markets are predicting that there's quite a few more coming. And CBA think there's 4. I think they're pretty clear on that. I think that's pretty much in line with everything that's going to happen. It'll be 4 to 6 rate cuts over the next 18 months that help bring the economy back into a normal setting. So this is huge news, and that's the big reason. As one economist put it, cut, baby, cut. The inflation result was a material surprise to the downside. The RBA has no reason to delay its easing policy. My God, they always use such fancy words. I like the cut, baby, cut. That's the nice, simple way of describing it. Cut, baby, cut. That's the scenario they're in, and that's what they're allowed to do right now. You gotta remember, the RBA aren't here being like, I really want to increase interest rates. I really want to hold everything back. I really want to slow the economy down. They're not evil people there being like, ha ha ha, I'm so powerful, let's slow everything down. They're there being like, inflation's too high, we've got to slow the economy down. That's what they're doing. Inflation's no longer too high, so they don't need to slow the economy down. They'll let it go into a more natural setting. The RBA are also needing to keep mindful of what the economy looks like in 6 to 12 months' time as well. If they keep holding it back so much, then the economy could be in a worse position as a result, and people will lose their jobs unnecessarily, and they do not want that. That's the other side that they're balancing here. So, what does this all mean for you? There are huge changes from changing the numbers around. Let's go through the main one here. Your borrowing power is going to rise. Every rate cut, you get a 2.5% increase in your borrowing power. 4 rate cuts, you get a 10% increase in your borrowing power. A 10% increase in your borrowing power, that changes property prices. It also means that the numbers look so much better. Let's play this out for a second. If you own an investment property right now, let's just say you bought in Perth or in Adelaide or in Melbourne, and you've targeted, hey, I want some income from my property investment. You're at a 5% yield, for example. You bought a property, you pay $1 million for it, just keeping it simple, you're getting $50,000 in rental income. Now, the loan on that property, assuming you've got debt for all of it, or you've taken money from the offset accounts to fund it, or you've got the money from somewhere, the loan on $1 million property right now, call it 6.5%, 6.75%. That means your interest cost is around call it $70,000 once all your costs are added in. You're getting 50 grand, you're spending 70,000 just on interest. Add another $10,000, probably 15, on all the other costs that you have. Every $1 million worth of property that you have with a 5% yield, which is much better than most property investments, is costing you around $30,000 in extra income, in losses every single year. There's a $20,000 spread in the yield that you're getting, in the rental income that you're getting, and the cost of money. Now, when you start dropping the cost of money down, 100, 150 basis points, that also comes down, and it gets much closer to being in balance. And that's just assuming you've bought a property recently. Most investors haven't bought in the last year. They've got some properties that have increased in rents, the loan balances have come down, the numbers look a little bit different, and it completely changes the numbers underlying a property investment. And for a homeowner, it's a different equation. It's about, do I rent or do I own? The cost of owning is coming down while the cost of renting stays the same, which promotes more people to go and buy a home to live in. It's just basic incentives. When you make something cheaper, more people want to do it, and the cost of owning a home is about to get cheaper again. Plus, people get more money from the banks to go and take on those debts to go and buy a home, and that just means that the numbers all change, and it promotes confidence. Everything is about to change from these rate cuts, and they're just about here. For property investors, there's a few key messages for you to take out of this. This is going to change the property market cycle around a little bit. Sydney and Melbourne will do well. Melbourne is something that I'd be looking at because I've been waiting for a trigger moment for Melbourne property prices to go from its downward trajectory to its rise back up again. And I feel like Melbourne's going to see a big benefit from this. If you're interested in other videos about Melbourne, I've been working with Adi at Alaya Property and done a number of podcasts with him, and now we work together at his buyer's agency to help Alaya Property with its investment strategy and work out exactly where to buy and why. I've been playing a role with Adi there and working together with him, and we've done a number of podcasts that we've released on this very channel. If you're interested in his number and the details around purchasing in Melbourne, drop me into the comments below in the description and you'll get a link to our website where we help people buy property in Melbourne too. Couple more final messages for property investors. You may want to think about your timing of investments. Melbourne looks pretty good right now. Sydney looks really good right now because nobody's buying in Sydney at the moment. That is always a good time to be buying in Sydney when nobody's looking. I feel like the market cycle in these major capitals is pretty much down here, right at the bottom. The best time to buy is around now. If you have all these changes that I'm just talking about, there's going to be more people looking, and there's not going to be magically more homes as a result, which increases the potential of property price rises. And let's get real, everyone. How often has Sydney and Melbourne just kept going down and down and down? There are periods to buy, and the period of buying is often better when nobody's looking. It is so much easier, and that period will not last forever. There's a buying window at the moment in these major capitals, and I'd be looking at different types of property investments as well. If I'm in these markets, I'd be shifting my demand away from the regional or the affordable markets and to the bigger capitals. The story of 2023, of 2024, of buying all these cities, Perth, Adelaide, Brisbane, it has done its time. It has absolutely shot its lights out. But if you want to be ahead of the curve, it's time to start thinking differently and adjusting to this new information. It is the biggest set of information that will drive property markets through 2025 and 2026. If you found this video interesting, do me a favor, hit that subscribe button and follow me along on my journey to keep producing content for you all.